Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, the professor himself, Mr. James Zhang. James, how are you?
Good. Thanks for having me. We're doing this live in person here in Vegas, so it's going to be a little different, I think, on this podcast.
Also joining is James, the lender, Wilson. James, how are you?
Doing great, Paul. Thanks for having me on.
So we are in Las Vegas, Nevada for the National Multifamily Housing Council meeting that happens once a year. It's an annual conference, obviously, that all the major players within the United States that have something to do with multifamily, whether they're investors, developers, lenders, equity people, management companies, you name it, that anything that has something to do with multifamily, they're here in Las Vegas. It's held at the Aria Hotel, and we flew in to see some of our 10,000 favorite friends that attend the conference. What we're going to do a little bit today is we're at the conference, and what we thought we'd do is just kind of share some up-to-date notes and some feelings and just part of conversations, bits and pieces of conversations that we've had with some of the players in the marketplace. Again, this conference really is not for brand new syndicators or investors that may have invested in one deal or two deals. I mean, these are the serious players from Blackstone to Wells Fargo to Regions Bank. I mean, it is the major players in this game that are looking to figure out what is going to be on the horizon for 2023 and beyond. So, James, I have some comments that I'd like to make, but give me your feelings about being here at the conference.
Yeah, I mean, I think the multifamily industry has done pretty well the past couple of years. I mean, really well. And so even with a little bit of softness, the back half of last year, everyone's coming in like, all right, we turned the calendar. It's time to go. Like, we got our allocation of money. We've got to put stuff out. And so I think depending on who you talk to, probably start with the listing brokers. Listing brokers are like, all right, this is going to be down for a couple months and we're going to be back. We're going to be back, baby, by spring break. Now, and then it'll probably go to the investors. Investors are probably thinking second half of the year, they're going to buy more stuff. And then, lenders are probably like, all right, I'm looking at my book, a business, my balance sheet, and I'm hopefully getting to the next year or the year after that where it's going to pick up and be a little bit more normal out there.
Yeah, let's just kind of talk just about a bunch of stuff on my notebook here. So, James, I was really amazed that there was that many folks that came to this meeting because they usually have about 10,000. I was thinking it was going to be about six or 7,000 people. Just a reduction of people just because, there's not been a lot of transactions that have closed in the last 9 months, certainly not like it was in the previous 12 months. And so if you're not closing transactions, you're not getting paychecks. You're not getting paychecks. You're not spending money to go out to Vegas conferences like this. And so I was thinking it was going to be about 6,000-7,000 people, but I would probably imagine it was 11 or 12,000. There was just a lot of people. James Wilson, your first conference for the National Multifamily. Give me some feelings, interpretations that you've had on being out here with us.
Yeah, Paul, first time here. Initial impression is there's a lot more people in multifamily than I originally thought. Dallas is a huge market in itself. There's a lot of players there. But you come here and it seems like nobody even knows most of the players in Dallas. It's just another person out here. There's probably, like you said, 10, 12,000 people. And it was just an endless stream of people at the conference that you never saw the same person twice, it seemed like.
No, it just never did. The professor, give me some of your impressions about, what are some of the comments that you're hearing from some of the brokers or some of the investors out there?
Yeah, I mean, I think the investors, I think the quote we saw was 98% of us want to buy and about 2% of us want to sell. So There's a lot of guys who want to buy, but it's at what price? And so I think trying to figure out the bid-ask spread between some of these deals, I think the more straightforward the deal is, so, it qualifies Fannie Freddie, you get the 60% leverage, there's a lot more buyers on that deal. Number one, because Fannie and Freddie are sort of a backstop. They're going to be there at closing. You're not going to get ghosted 1 week before close and, not have a lender So number one, there's good agency debt options right now. 10 years come down probably 50, 60 basis points from the beginning of the year. So I think everybody likes that, and they don't have to buy an interest rate cap or any of that stuff. So I think that's number one, is the debt's there for these buyers, but then also their investors want to be a part of that story as well. So people, whether they knew or didn't know, a lot of these deals the past couple of years were bridge loans and these interest rate caps. I mean, I think our first meeting, this conference, we were talking about capital calls, and because of these interest rate caps and the cost of them, and the Fed went another 25 this month, and people are hoping 25 basis points on the next one, and then the craziness will stop. So the cost of these interest rate caps just keep going up, and until that subsides, these escrows, people are going to have to buy these interest rate caps, and the costs are just super high right now.
Let's go back to just kind of talk a little bit about where the market is right now. Talking with some of the brokers and some of the investors, there's such a large delta between what the buyers are willing to buy and the sellers are willing to sell. I mean, the buyers think that these properties are worth a lot less than they were, 2 years ago or 3 years ago. So they don't want to put money out to buy something unless they could see a little bit more distress in the marketplace. And the sellers who bought these properties are like, my property's worth more than I paid for it 2-3 years ago. And so we're not going to sell a property that we may be losing money on. So I think with the general feeling that I felt out there was, a lot of folks are just waiting for one large syndicator to default, or crash, I think that will shock the market. And when that shocks the market, it's going to make the investors and the GP really come to terms of really what's going on out there. And just like what James was talking about, last, say, 3 years, a lot of these loans were tied to bridge loans. And so, they're going to have to make a decision on what they're going to have to do, whether it's recapping a deal, which means bringing in additional capital into the transaction, supplemental capital. So we've seen a lot of folks, that put $100,000 in, and now some of the general partners have been asking for $25,000 additional, just maybe to pay for a rate cap onto the deal. So they're having to raise more capital. Two is that they may have to refinance the deal to take it off of a bridge loan, take it off that adjustable rate, try to bring it into a fixed rate, and then kind of kick the can down to go with a longer term of the mortgage, because a lot of these bridge loans were really set up for only being 3, 4, 5 years. But if you do it like a Fannie Mae loan or do it even a HUD loan, you can bring it out to, say, 35 years on the term of the loan. Or, the other option is to sell the property. So I think if people see maybe there is a default on one of these large syndicators, I think it's going to shock the market, and people are going to start taking action at that period of time.
Paul, why do you think somebody would default or give up on a deal? I mean, when we're talking with people, there's a couple of reasons I think that people aren't giving up yet, and we're not seeing a lot of transactions, right? Because if you just bought a deal in 2022 on a 4 cap, and now the broker's saying, hey, I just sold you this deal. Hey, do you want to sell it for 30% less? They're not getting a lot of calls back. And so, the only reason I think someone's going to default right now is they have a forced maturity, but most of these deals were 2 or 3 years out. So to me, it comes down to cash flow. We saw one of the big guys in this space, Grant Cardone, and his sweatshirt said cash flow. And I think it's a huge deal right now, just because, most of the time you're thinking, I'm investing in real estate, I'm going to have positive cash flow, and I'm going to quit my job, and I'm going to have all this cash flow coming in my mailbox every day, or ACH to me. But right now there's some negative cash flow deals, and that monthly burn is something that syndicators have to figure out really quickly.
It's almost like creating a technology company that has investors that put money into these technology companies, and they have to kind of determine what their cash flow burn is. At some period of time, if the money stops coming in and you keep on burning through the money, what happens? And that's been a big thing with these interest rate caps. I mean, you've heard some stories out there, James, and how concerned are you about that stuff?
No, I think this is the time to bring the airplane analogy back. Okay. And we're going to start. So the airplane analogy is, you find a deal, and there's a couple captains in the front, and then all the LPs are in the back, and you take off when you buy the deal. And then, you're sitting up there for 2 or 3 months and making sure, 2 or 3 years. And then you got to land the plane. Right. And so, a lot of people had some trouble getting up to Vegas because we could not land the plane. And so, some of these bridge loans, there's just not enough runway, right? So you hit the runway, you might hit some ice. If you can't land that plane and land it on the runway, you're gonna have some issues. And so I think that's on the foreclosure side, on the default side, people are trying to figure that out for their existing portfolio. And to me, if you got capital calls coming, it's gonna be hard to raise money.
Yeah.
The guy that invested with you a couple years ago, they put 100,000 in. Now you're asking them for 25. They're saying, "What are you talking about? I thought you're supposed to send me 25,000. Why am I sending you more 20?"
Yeah, these syndicators are really. I like this phrase. They need money like they need oxygen. And so if there's not a lot of money to put into these deals, a lot of these deals will fail just because of the rents have come up, but they haven't come up to what their pro forma said, say 2 years ago, to have an increased NOI. The cost of the interest rate itself has gone up, and the cap rates that have these maturities that have to be renewed have gone from $50,000 to $1 million, and so that throws off a lot of problems through your cash flow burn rate on these deals. And so it's not because of the property itself, it's just the structure of these deals, what they were done, say 3 years ago. So that's what our concerns are too.
And if interest rates hang out, around 5%, like they're kind of saying, like JP had said last night, it's going to be even more difficult, like you said, to have, like, cash is king right now for some of these deals. And a lot of people need that money to hold on and survive to 25 is kind of the theme that we're going with this year.
I like that one. Survive until 25. That's great. So a couple of comments that we've heard from some of the listing brokers is that the market must be stronger before I list. That's what, again, we're hearing from some of the top listing brokers is of conversations that they've had with sellers. Another thing is that what they're instructing some of their sellers to do is that if someone's buying one of your properties and you still want to get this deal closed, but the buyer cannot raise enough equity. Let's say they need to raise $10 million, but they can only raise maybe $8.5 million. And they've come to you for an extension, it may be a month or 2 month extension, so they can go out there and raise more money. The listing brokers are being advocates to, hey, listen, if you still like this deal, well, how about if you invest some LP interest in the deal? So, James, what's your take about that?
We're just going to keep going on this airplane. So, imagine you take the plane out to Vegas. There's some weather in Vegas. Oh, we're detoured. We're going to Albuquerque or we're going to Phoenix, and you're going to be on the connecting flight. So, some of these sellers think they're going to Vegas. They're stopping in Albuquerque.
Yeah. So, if you like the deal and you want to close and sell this deal, you may have to put some additional equity into the next buyers transaction. So that is something they were kind of talking about too. They also feel that there's going to be a lot more buying opportunities coming in the third and fourth quarter of 2023. And some of the things that the new buyers are asking out here is that they want to see 2,000 or newer value adds. So I think they're done with the 60s and 70s and 80s properties to a certain level. I mean, if there's always exceptions, there's some good properties out there in that age range, but then they say, well, what do you guys have for 90s? We want 90s products now. I guess 90s is the new asset class. What's the problem with that one, James?
No, I think what's cool about coming out here is there's some guys who have been in this business for 30 or 40 years, and they have 10, 20,000 units, and they asked me, what do you consider Class B? And I'm like, maybe late 70s, early 80s. They're like, when I started in the business, an 80s deal was a Class B. It hasn't changed in 20 years for some of these guys. So, listing brokers or whoever, everything's a Class B now.
Yeah. There wasn't a lot of 90s products that were built. In fact, there was probably nothing because at the end of the 80s, going to the 90s, it was a savings and loan problem. And that's a lot of builders couldn't find financing to build apartment buildings for the first half or almost the whole decade of the 90s. So they just don't know what they don't know.
Is that just Texas or is that nationally?
That was national. So, a lot of lenders just were not in a position to do that. Other things that they were talking about, that they still feel there's a lot of demand, and that Blackstone is buying Class A buildings with cash at 5% cap rates. So, yeah, yes, they are selling, but they're also buying out of their other pocket 100% cash. So they're not putting debt on these deals. I think they're waiting for interest rates to come down a little bit at that period of time. They'll probably refinance into to long-term fixed rate or adjustable rates at that period of time. Things that they're talking about is, out-of-state guys still want to develop in Texas. They kind of want to start in Dallas and kind of figure it out from there. But still, a lot of people are trying to figure out what's the cost of the land, and is our cost cheaper in Dallas than it would be in someplace else. So we're still seeing a large push for buyers, and it doesn't have to be institutional construction people to buy the land and build, but it's still, a lot of mom and pops are wanting to build apartment buildings. James?
Yeah, a couple of things. We talked to some developers, and I was like, what's the cost to build in Texas? New piece of dirt, let's say garden style deal, and they were probably around $250 a door to build this stuff. And I think, after COVID, some of these costs have come up, but then also a lot of these developers, they have to use a construction loan that is 3 years, and it might be floating rate. And so just the interest cost to get some of these shovels going went up, doubled or tripled. And so it's just a lot harder to build. And so I think, a lot of people built the last couple of years, but, as these rates are sitting up at 5% on SOFR, it's going to be harder and harder for these guys to build.
Yeah. And not all deals, when they're trying to buy an apartment building, just a regular syndicator, it's not always the better price, the highest price that wins. It is the confidence for the seller to have with the buyer that they can actually raise the capital. There's been so many, brides that were brought to the altar, they never got married. And so now they're not looking at the highest price, they're looking at the competency of the buying group to actually close. And so that they're looking at that a lot more. One of the things they say is a lot of international buyers are still in the market. They want to put money into the U.S. The domestic buyers want to invest in Texas, and the regional players want to invest in Austin and in Dallas.
Let's talk about, I would say the second or the two words that were probably said the most here were pref equity.
Yeah.
So let's get into pref equity. And
you're not going to go back to the airplane analogy, are you?
Oh, well, if you want to go back to the airplane, let's go back to the airplane. There's a lot of guys in Dallas who went to the airport 4 times to try to get here. And, in Vegas, there's a lot of people at the airport still waiting. So, yeah, imagine going in, you're boarding the plane and you're like, man, all these first class seats are empty. Well, guess what? They're about to be taken up. So pref equity comes in front of you in the stack in the airplane. So they're going to get on the plane and sit in first class, and they're going to get paid first. So imagine the food cart or the drink cart coming down the aisle from the front of the plane. Guess what? They're going to serve the first class guys first. And if there's anything left in the back, that's going to the common equity.
Yeah, I certainly love your analogies, James. Again, the general partners, sponsors are in the front. They're the pilots and the first officers. Us people in the back, which are the common equity, limited partners in the deal, and the pref is in the first class. And again, they get paid first, they eat first, they get their Coke, and hopefully we get our peanuts in the back of the airplane. But if they see any problems, if you have somebody that has gotten into an agreement with pref equity, they can actually jump into the cockpit and start flying the airplane. And so that's always our concern, is that when you have a pref equity piece and you don't have the fractional ownership interest in these deals, is that they, for some reason, they feel that the airplane's going in the wrong direction, or the pilots are not good as what they were originally proposed with, is that they'll kick open the cockpit door and start to fly the airplane themselves. And that may be to the detriment of all the limited partners in the back, which may have an eventual problem.
Yeah, I mean, the reason that pref equity is coming up is, I would say, first off, if you're in a deal right now and you did a bridge loan, let's say 70% or 80% LTC, now you come to refi because, SOFR went up a lot, your caps are really expensive. You go to refi, you're a little short. So your bridge loan is $20 million, your Fannie Freddie loan is $15. And you go back to your common equity, your LPs, and say, hey guys, we need $5 million. I know we put in $5 million, or we put in $10 million. Now we need another $5 million. And that's just a big check for guys who are normally used to writing $100,000 checks. That's a lot of money to go out and shake everybody up. And they're saying, why am I going to contribute to this deal? So it's going to be harder to do these capital calls. And so the pref equity, the reason they're coming in is the reason that to bring in that new money, that $5 million, they want a better seat on the plane.
Yeah. Other comments that we heard were a lot of folks are just assuming current loans that are in the marketplace. So if somebody had a fixed rate that they bought a property with a number of years ago, and they still hold the property, that's a little bit of the way that these deals are getting done is through assumptions. And they may be at 50 or 55% leverage, but it's a fixed rate, and they usually don't have to pay with a fixed rate an interest rate cap on the deal. James Wilson?
And a lot of those assumptions are really low interest rates, 3%, 3.5%. So when you do have the pref equity come in on top of that, the blended rate is still attractive and the higher leverage.
Yeah, let's talk a little bit about underwriting. I mean, another current theme that we heard is that insurance is outrageous. The cost of insurance to insure these buildings is a huge number these days. I mean, we used to underwrite these deals at $325, $350 a unit. James, what are you hearing out there?
No, I mean, so imagine when you go to refi, you're not only, your interest rate is higher, I got that, but then also they're going to underwrite exactly what's on your P&L, right? So they take a T3 on your revenue, let's say on your net rental, T12 on the other income, and then they look at your expenses. You can't just take payroll down to $1,000 a unit. If you've been running this thing at $1,500 a unit, guess what? They're going to use $1,500 a unit on payroll. And I know your T12 on insurance says $500 a unit, but in December you renewed for $1,000 a unit. And so now they're using insurance, that new number, because you're paying insurance that first full year. So insurance it's almost mark to market right now. And so you can't just make up a number. They're not going to look at your T12. They're going to look at the next 12 months. What are you going to be? And so it's a little tricky right now on refis because they're marking that insurance to market right now.
Again, interest rates have gone up, and that's causing a distress in the marketplace for a lot of the servicers. So remember, when you originate a loan, that loan officer's good with you for about 60, 65, 70 days. But then when the loan gets funded and the loan is now into the lender's system, it's serviced on the back end by a servicing agent, a servicing person. And they're with you for, if it's a 10-year loan, 9.5 years or so. So that segment of the business, because of the distress, is starting to thin out. A lot of servicers have multiple problems or issues going on which they didn't have a year ago or 2 years ago or 3 years ago. So a lot of the servicers that are currently looking at these deals, they're 6-7 months behind in their analysis, which they have to feed up to their people upstairs. And so they're looking at deals, trying to figure out what's going on in September, October of last year, where if they were to look at deals today, if there's any level of distress, they would put a lot of these folks on cash management. They would not have rehab dollars to be spent because they haven't met their debt yield requirement. And one of the things that I think a lot of people don't realize is that, and there's a difference between the loan documents between Fannie Mae, Freddie Mac, and the bridge lenders. The bridge lender agreements are kind of like all over the place. Think of an analogy, I'll go back to James, of a snowflake. Why is that important, James, with these bridge lenders?
Yeah, I mean, we're sitting here and it was a little bit colder. You know, people come to Vegas, they're thinking it's going to be 110 degrees. Well, it's 30 degrees. And, you know, we got snow in Dallas, which, you know, maybe once a year we'll get snow in Dallas. And, you know, you're looking outside and each one of these snowflakes is different that you're looking outside the window. And it's the same way with these bridge loans because each lender, they're going to underwrite, they're going to have their own loan agreement. Okay, I got that. It's 110 pages. And they send it over to your legal counsel. And the legal counsel takes out their red highlighter or red pen and starts marking it up.
I'm going to strike that. I'm going to strike this information. I'm going to strike that covenant.
Yeah, so each one of these things is unique. And so now think about you're a servicer. You have 200 bridge loans or 150 bridge loans, and each one of these is different, and you're supposed to track it. Is it month 11? I don't even know what month it is, right? So at month 12, you're supposed to have a test. At month 18, you're supposed to have a test. All these different things. And I'm not saying I was ever in servicing. I was an underwriter. But, you know, once we underwrote the deal, it went over to servicing, and servicing doesn't get a lot of love. So they're usually not on the fancy trips. They're usually...
No.
And are the servicers, are they the senior guys or the junior guys?
So they're the junior guys. I think there's a famous rap song, "Starting from the Bottom." Well, in loan servicing, you're basically starting from the bottom. And so these guys, they might look at the loan agreement and it's 150 pages, and it's been, legalese all the way, every word. You'd have to look up the definition in the front of the loan agreement. So it's very difficult to figure out some of these loan agreements.
They cannot. It's a little bit different because the Fannie Mae, Freddie Mac loan documents are kind of promulgated documents. They're really not going to change very much throughout the country. So these are national loan documents. There may be something per state, but they don't change the general terms of the deal. In these bridge loan agreements, some of these terms are different because the buyer or the buyer's counsel has struck stuff out and that was allowed by the lender. Now, as James Wilson said, yeah, these are sometimes junior people that are working this stuff, and they don't understand the language. Well, the buyer doesn't understand the language, and so it's difficult to put it on an Excel report to kind of follow up. So these folks are 6-7 months behind just going through these documents and seeing what triggers they are. And one of the things that James brought up is that, on these bridge loans, they have the ability to grab the cash, put to the side to do the rehab. Well, they were supposed to spend $2 million, or they told originally they were going to spend $2 million. And now they're needing a check for $1 million because they just spent $1 million. And they found out they violated a covenant that their NOI wasn't at a hurdle that it was adequately able to go over that hurdle. They actually are below that hurdle. So the lender was like, well, we can't reimburse you for that because your NOI, your debt yield is so out of whack. That comes out of your pocket. Because remember, the bridge lenders are cash flow lenders. They're not really based on your balance sheet. They're not looking at you for additional collateral. They're just looking at the property and the condition of the asset and the cash flow, the cash that's currently generating at this period of time. So that is the snowflake analogy that James put out there. The no one agreement is the same. I'm going to follow up with James Wilson again. You wrote some notes down. I mean, what were some of the things that you felt being kind of a new person to this large gathering? Some of the people that you spoke with. Again, we were out. We're currently in Las Vegas right now, but we were on the floor at our booth for 3 days standing up, 3.5 days standing up. And what were some of the comments that you heard?
Yeah, we caught people as they were coming by. We got a lot of good takes. One of the themes that I wrote down that we kept seeing was reset pricing. Everyone's waiting to see what the new pricing is going to be. I mean, I think every seller is aware that the market's changed. Obviously they don't want to sell for a loss, lose their equity. They're going to hold on as long as they can. But, everyone's in a consensus that reset pricing is needed. So where that shakes out, we'll see. Another thing I had down was, having liquidity at the property level, just having that cash, kind of cash management so that you can manage the property and hold on and survive. But how is that going to work out with the bridge loans if they start sweeping that cash in the cash management?
Survive to 25 is the big thing.
Yeah, I mean, I think it's important. They sweep the excess cash, right? So let's say your property is making $100,000 a month on the rental side. Your expenses are 50%, all right, 50,000, and then you pay your debt. It's 30,000. The problem is, and let's say there's an excess 20,000 that is there. They'll sweep that cash if you're not hitting your debt service coverage, at month 18 or debt yield in month 18. The challenge is it's going to be negative cash. There's not even going to be cash to sweep. People are going to have to contribute to the deal to make up that cash flow. And so that's going to be a challenge. And you might have let's say you have a bridge loan coming due in December of 24. Okay, that's fine. You have a little time, but your cap matures December of this year, and you've got to buy that cap. And so I think that's where not only you're going to have property cash flow stuff come up, but then also at the deal level. And so what we've seen is a lot of people have refinanced to fixed rates with maybe shorter yield maintenance just to relieve that pressure if they can.
Yeah, another takeaway I had from the conference was, people were starting to ask for smaller deals, 50 to 100 units.
Oh, good point. I like that one.
And I think that's because the equity raises are getting more difficult. So we might see some more competition in that kind of space.
So, let's talk about some of the positive things. I think that's a positive thing is that I think people who have been trying to buy the biggest, baddest property out there are starting to be more of a realist of what they should be buying in that space. let's talk about some of the positive things, James. Anything that you thought, coming down the pike that people could be positive about?
I mean, we're at the source of the report that was quoted more last year than any other report. There's a shortage in housing. I mean, there's no doubt. I mean, whether it's in Dallas or Houston or any of these places, there's a shortage of affordable housing. The number of Class A deals coming online this year, you can read CoStar, you can read Yardi. I mean, it's anywhere from 350,000 to 450,000 units. And I don't think anyone thinks all of that's going to be absorbed this year. So there's going to be a little bit of an excess on the A side. But on the B side, I mean, I think most people are still saying positive rent growth this year on the B side. And the C stuff, I think you just have to make sure that you keep your property up, make sure there's enough CapEx, enough liquidity at the property level to handle some of this stuff. And so I think, I think everyone's making a big deal, like occupancy is going down, but it's coming down from a peak that was like unsustainable. I mean, it was 97, 98% on a national basis, and it's come down a couple bases, 2-3%. So maybe it's 95 today. So, I mean, I think relative to everything else out there, you've got, diversified tenant base, you've got Fannie and Freddie to backstop your deal. Your pricing's better than it was last year. Investors still want to come into multifamily as an asset class. And so you have all these good things going for you. I think you just have to pick your shots right now and make sure, I would say number one, take care of your existing deals, right? Take care of your old stuff, and then your current deals, make sure those planes land. And then before, you don't want to be a pilot taking off a new plane when you got 3 in the air.
I think we've talked about this, and I think this was an important point, is change the narrative. Change the narrative to your investors and the general partners is that don't think that you put this money in to invest and you're going to be able to get 40, 50, 60% rates of return within a year or two. Those days are over. Thank God they're over. That really wasn't a realistic piece of the deal. In that, I've learned for a long period of time that if you have these long maturities, that you can take these loans out for a long period of time, and then you do have these fluctuations of interest rates going up or insurance going up or anything that's going to affect the operating expenses in the property or even the income expense, the income piece of the property, is that those will level out over a period of time if you have long maturities. So change the narrative for your general partners. And if you are an investor, think about trying to go on to the longest term possible. Try to maybe do a HUD loan. Try to do maybe a Fannie Mae loan that has an extended term. Maybe bring it out to 7 or 10 years. Don't, find a way for, if it's a 10-year loan, maybe 7 years of yield maintenance in the last couple of years of a step down prepayment penalty or 0. And there's ways of structuring these deals that if you want to get out early, you can with a limited or lower prepayment penalty on the deal. So a lot of these deals that if they don't, they're trying to survive and they're asking you for money. It may be a cash in refinance, but you don't want to have a cash in number today just to kick the can down the road and have another cash in number in 2-3 years from now.
All right, last airplane analogy. So think of us as the air traffic controller is what Paul taught me a long time ago. So air traffic controller, if you have planes in the air right now, you've got to figure out where those guys can land. And unfortunately, we talked to some guys coming out. They were on the runway for 3 hours burning gas and had to turn back and fuel back up. So on some of these deals, I don't know if we can fuel while in the air, but we can figure out where you can stop, fuel it up, back up, and, get to your destination. So I think reach out to Old Capital, figure out what deals are in the air or what planes are in the air, and get those to their destination, and then get in front of us on new deals, because a lot of these deals, they're not even hitting the market. I mean, I think some of these deals that are going on the market, the thing we saw is, the last 2 years, they tell you the whisper price, and they might blow through that whisper price. It might go to 120% of the whisper price.
Sure. Just
because of so much competition. But I think some of these brokers are definitely using let's start at a low whisper price and let's get some people in the mix committed to this deal. Let's get some tours going. So we're seeing a lot more tours. So we'll be out there when we get back to Dallas on some tours of these deals. But yeah, I think more people are going to start looking, especially as it gets a little warmer.
Yeah, be an advocate. If you're sitting in the back rows of the airplane, make sure that you let the pilot know that you keep ringing that buzzer in front of your seat. Ding, 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 ding. That you want to have the Coke and the peanuts and you want them to land the plane safely and not have any problems. All right. So don't forget, coming up here this month, February, and then in March, we have 2 presentations that we want you to come to and we want you to see. So James, tell us a little bit about those.
Yeah, so the first one, Greg Willett, he's with IPA. They see a lot of data on the Class A side and also sort of across Texas. So February 13th, go to oldcapitalpodcast.com. You can register for that one with Greg Willett. That's a Monday, I think, right before Valentine's. And then the second one, JP Conklin with Pinsford, is sort of the interest rate guru that we love to listen to. So that's I think the second meeting this year for the Fed. So we're going to get his fresh take on what's going on with the Fed and if there's another hike after the March one. So register oldcapitalpodcast.com.
All right. I'm going to have last word from James Wilson, our neophyte out here looking and talking to all these people. Any last words, James, that people I think would want to hear?
Yeah, I think everyone's opportunistic. I think everyone's still excited to be in multifamily. They just want everything to kind of level out, smooth out, know where we're going. But I'd say everybody's still positive in the industry. So that's my takeaway from this event.
All right. Some great information from James Wilson. Thanks for being part of the team. James, the Professor Eng, always a pleasure. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.